Kalimera Seolus Kaikalos, Hirtetes OKONOMIKA. Welcome everybody to OKONOMIKA, all about economics and finance. And if you're new around here, please subscribe to my channel. You will be greeted with the most important updates on macroeconomics and the stock market and everything in between. So there has been a lot of noise around Friday gilts market sell-off, although the whole stock market was selling off. Basically the AI asset bubble. So I decided to clarify why the gilts market, the UK sovereign debt market, has been so volatile. And definitely it's not due to what rose up on the newspaper, so that the fiscal policy or the Chancellor of the Exchequer decided not to hike taxes or some stuff like that. That's definitely not the reason why bonds, the yield curve is volatile. It's definitely not because there is a headline on any UK tabloid or newspaper or anything that comes up on the 24/7 rolling coverage of the news cycle. That's definitely not the reason. And I will prove you empirically what I'm saying with hard data that, of course, people who work in the mass media industry, they have not the farthest clue of what they're talking about. And okay, so let's start first. We see here that the 10-year UK gilt yield, it jumped something like 150 basis points, or 0.14 or 15%. It was sitting very quietly around 4.4%, and then all of a sudden, Friday evening, we close at 4.58. So it's actually a jump of 180 basis points, or 0.18%. in the cost of borrowing on a 10-year tenure. If we see the 30-year, wait for the page to load. Again, we see the yield at its low was 5.16 and change, and all 16 and something, and then it jumps up at 5.4%, which is a very large, very large jump in the yield. It's 16. It's 24 basis points, 240 basis points. It's huge. It's a huge movement. Although that's the 1-year chart. If we narrow down the 1-day chart, okay. So I have to be more precise. I apologize for the mistake. So okay, if we analyze, okay. So the 14th of November. So we closed from between the 13th and the 14th of November. We have a jump from 5.23 to 5.36, which is 130 basis points. Then we end up at 5.40. So we start at 5.23. Okay, it's around 170 basis points, give or take, and it's actually here. The data here, it's accurate and precise. So we can take it as very precise what the table here describes in terms of intraday volatility and also end-of-day volatility. So we start to understand the first basic things. Okay, here we have UK 10-year sovereign debt. The yield mark to market at the end of Friday, it's 4.58%. That's the market yield, and there is the coupon and all the rest of it, which I cannot explain. We see here that for the year, for the whole 2025, actually the yield, it has increased by 0.11 or 112 basis points. Okay, so it means that the 10-year gilt, it has a higher cost of borrowing, or it has a higher rate of return compared to 2024 by this amount, 0.112 basis points. Okay, that means that the same time last year, the 10-year gilt yield was 0.47. Sorry, it was 4.47. Okay, so if we take the yield at mark to market now, we subtract the premium that has been added this year. So last time last year, the same time, the 10-year gilt yield was 4.46.8. Let's call it 4.47, right? But now, this year, the mark-to-market yield at the Friday closing was 4.58. So the cost of borrowing compared to the path to 2024 has increased by 112 basis points. And please don't just go AY with your mind and start to make any sorts of judgment. Okay, you need to look at the numbers and understand the mechanics of what happens. Okay, so that's because all the stuff that happens with the yield curve, it has to do with fiscal policy, but it's not only fiscal policy, because there is also the Bank of England. And what happens in the banking sector and the overnight liquidity within the banking sector and the reserves, the level of reserves within the economy. So those are all major factors that determine the demand and supply of debt, and how debt, in this case gilts, are traded into the market. And I will show you now what actually, not the only reason, I will show you, very quickly, what is happening. Here you can see, then we will jump back to the yield curve, because I know that the attention span of people is less than 30 seconds. So the blue line is the Bank of England balance sheet, okay? Now we narrow down from the start of quantitative tightening, so the active sales of sovereign or gilts from the Bank of England into the market. You see that the balance sheet goes from 970 billion, and we are now, not now, but at 29th of October, it shrunk to 630 billion, 290 million, okay? So if we do a rough rule of thumb, 973 billion, let's call it billion, minus 630 billion, so the Bank of England, it has played around 340 billion, it has sold into the market, into the public market, and within the UK banking system, has sold back around 340 billion of gilts, 340 billion pounds sterling of gilts, UK sovereign debt, okay? So the Bank of England, it has been actively reducing the balance sheet, such as the Federal Reserve or the ECB, and that means that it's withdrawing liquidity from the overall levels of reserve and the general system of interbank liquidity, or interbank liquidity, the banking system, okay? I'm sorry if I just stumbled upon something. So the Bank of England is draining off liquidity from the financial sector, okay? Mostly it's from UK banks. So it goes into the market, it does an active sales of gilts, or probably rolls over the debt until it holds the debt to maturity, and it does not roll over the debt. So at the same time, what happens? We all know what is quantitative tightening. So the Bank of England has sold 340 billion of gilts. What has happened on the other side is that if we look at this column here, we see that there is weekly amounts outstanding of repos, okay? And yes, okay. So what do we see? That at the same time that the Bank of England it has been shrinking the balance sheet, and it has sold 340 billion. These 340 billion pounds have been drained as a liquidity from the banking system or the wider financial system. On the other side, what we see is that the use of the repo facility, it has increased. Now, what is repo? Repo, the Bank of England provides two types of repurchase agreement. What that means is that actually the UK banks take sovereign debt, they give it to the Bank of England as a collateral, and for the face value of that sovereign debt, they take cash. Okay, what is worth sovereign debt? £100, they take £100 from the Bank of England, and in a week time, they pay back to the Bank of England those £100 that they have received as a short-term liquidity, because repo facilities, they have a duration of 7 days, maximum 14 days for what concerns short-term repo here, short-term repo. And there are also long-term repo agreements, which they have an expiration date of 6 months. So the Bank of England has tried to shrink the balance sheet by roughly 340 billion, right? But what it has been happening at the same time that the Bank of England has been withdrawing liquidity from the financial system, we see that banks, as they have, on the other side, they have tapped the Bank of England for liquidity. And any central banker will tell you that this is the way it has to be. So that repo facilities, they are there to provide liquidity into the market, short-term liquidity, because quantitative tightening, it's a long-term operation, let's call it like that. So once the Bank of England, as the central bank, has shrunk its balance sheet That's the way it is, okay? Then short-term liquidity is provided via central banks, from the central banks, or by the central banks via repo, short-term repo, or discount facility windows, and they have all sorts of tools that are there, and they have to work in this way in order to guarantee that all banks can function. The banking system, the financial system can function properly, and so that there are no dangerous shortfall or liquidity between one business day and another, or between 1 week and another. Okay, otherwise we find ourselves in a situation of distress, liquidity distress into the system. Okay, so the repo facility, the short-term and the long-term repo facility, they are working fine, but we need to take stock of the fact that the repo facility, it has grown a lot. So the Bank of England started selling gilts in 2022. At the same time when they began hiking interest rate, so when they basically changed their monetary policy stance into a restrictive monetary policy stance, or restrictive monetary policy stance. I don't know how can I put it better. So they hiked interest rate, and they said, okay, now we're going to start quantitative tightening. We start to sell, we'll shrink our balance sheet. And we see here that, for example, at the start of 2023, or in the beginning of 2023, we have the first 1.5 billion in short-term repo, okay? And we see here, we get by the end of 2023, we have 2.4 billion, 4 billion in bidding for the repo facility. And now, all along 2024 and 2025, we end up here, the past week, which was Thursday on the past week, the 13th of November, but because these are weekly operations, we have a repo facility activated on the 30th of October. 7 days is the maturity, and it expires on the 6th of November, and the overall amount, it's 97.8 billion. So the repo facility, it has been growing a lot, right? So what that means that the Bank of England has sold its gilts, but at the same time, the banking system, the financial system, is taking again those gilts and is posting those gilts as a collateral to ask for short-term liquidity. So, in this sense, we can gather an idea that all this movement back and forth of sovereign debt, and usually the collateral is the 10-year gilt, the 30-year gilt. I don't know, on this table here, I don't have the specifics of which bond has been posted as collateral, but so all this back and forth of gilts used as collateral for the repo facility, of course it creates volatility. And at the same time you have quantitative tightening, so the Bank of England from time to time sells gilts, and that creates volatility in the yield curve. So by the 20th of November, in 7 days time, Thursday in the coming week, there are 92 billion of short-term repo. I don't know if it's basically refinancing the whole 92 billion, but from past week to the next week, we go from, okay, so the overall amount now is 92 billion, okay, let's put it in thousand. The past amount was 85,687, right? So there is an additional 6.3 billion which has to be repaid from 1 week to another. And the repo facility, it has expanded by 6.3 billion. Of course, if I have an additional 6.3 billion in bonds, which is gilts, moving into the market, of course it creates this kind of volatility. It is mechanically what happens, okay? If I have banks that scramble all together for liquidity all at once, and they're not asking for nuts, okay? They are asking for an additional 6.3 billion in short-term liquidity that lasts for 7 days, then it means that there is need for liquidity into the system, right? And the same if we take the data of the long-term repo operations. So these long-term repo, they are done with the inflation index linked gilts. So those kind of UK sovereign debt, that basically it's linked to the rate of inflation. So it's issued at a certain yield, and then it has a multiplier which is calculated on the rate of inflation, and so you get to the full rate of return of the bond. Okay, so the inflation indexed debt, it's used for 6-month term repo. Okay, so it means that today I go to the Bank of England, or you go to the Bank of England, and you give your bonds, which are linked to inflation, so the indexed inflation linked gilts. You give it to the Bank of England. Bank of England give you some money which corresponds to the face value of the bond, and then in 6 months' time you will have to pay the Bank of England the money that you received plus some premium, which is the borrowing rate of the repo facility. Okay, so which is typically around 4%, or not 4%. It's typically around the repo rate. It's set by the central bank, and it corresponds to the bank rate plus a spread or a premium. Okay, because the bank rate is 4%. The Bank of England interest rate benchmark is 4%, and that is for deposits. So the repo facility, it allows you to earn a spread above the deposit rate. That's what happens mechanically into the market. Okay, so I set the bank rate, and then deposits are 4%. Okay, then the repo allows me to lend money at 4.25. So I earn 0.25, a quarter, or half a percentage point. Okay, that's what mechanically not happens. That's how it works. Okay, now I didn't have time to go and check what is the Bank of England repo rate. I can do it quickly now on another page, and I will tell you the exact data. But more or less, that's how it works. The Bank of England is at 4%. That's the deposit rate, or the interest rate that should correspond also the yielding bank deposit, although it's not like that. Then the repo, it's 4% plus a spread. That's how it works. Okay, so now we see here that also the long-term, the 6-month repo facility, which is activated with the inflation-linked gilts, and you see here there is level A, level B, and level C. So level A, level B, and level C, those are 3 types of debt or financial security collateral that the Bank of England accept for this kind of facility, liquidity facility. Level A, we suppose, is Premier League level. Okay, so it's top quality collateral, sovereign debt. Level B is some other kind of collateral which carries higher risk, and it has a less quality. So it's not sovereign debt, perhaps it's corporate debt. Level C, it's even a lower quality collateral, which can be occasionally, I don't know, some sort of not that I don't know. I have the page from the Bank of England which defines clearly which kind of debt securities are defined as level A, level B, level C. But the main concept here is that level A, for sure, is sovereign debt collateral, so it's inflation-linked gilt. Level B, it can be some kind of corporate debt. Level C can be even lower quality, so it can be some debt derivatives, or can be some mortgage-backed securities, that kind of stuff. Okay, so level A, level B, and level C: higher quality, middle quality, lower quality of collateral. So the Bank of England, with the 6-month window repo facility, accepts 3 different types of, more than 3, but it has 3 levels of debt securities or financial securities that they can accept to provide liquidity. So in this sense, we can understand that the central bank, it has been trying not to be excessively restrictive in order to make sure that the financial system works, and it has day-to-day or week-to-week or month-to-month liquidity and an adequate level of reserves. Okay, and here, these data, they are really poignant to what happened in 2022, because the Bank of England, okay, they say that they had a very short-term, like last weekend, a short-term window where they were open to accept any sort of collateral, even level D, level E, level F, level Y, X, Y, W, whatever. Okay, so they were accepting all sorts of things as a collateral to provide liquidity to funds, the hedge funds, pension funds, or banks, which were under severe stress because of interest rate volatility, because of hedging in the swap market with inflation-linked swap, and all that sorts of very complicated stuff. So they were all in the wrong, on the wrong side of the macroeconomic variables, because in 2022 you had higher, very rapid rise in interest rate, and a huge double the amount of interest rate, a huge increase in inflation. So all those funds which utilize the repo facility, they basically they replicate they do something which is very complicated. They hedge funds or speculative funds, they take sovereign debt, they take UK gilts, they give it to the Bank of England as collateral, they take those money and they use swap to replicate the exposure to the yield curve, okay? And they hedge their exposure with very complicated bets, which in this case, in 2022, they went haywire because they utilized also inflation-linked swap. So it means that they were long the swap, so they assumed that they were paying a fixed rate of based on inflation. They were receiving a fixed rate, they were paying a variable rate of inflation. So when inflation goes up, their leg of the swap goes down, so they have a margin call. So the value of their swap, the inflation-linked swap, goes down. The same is for the interest rate swap. Okay, if you are paying the variable rate and you are receiving the fixed rate, when interest rate go up, the value of your swap goes down, and then you have a margin call. Okay, so all those funds that they used, all these sorts of complicated swap, credit derivatives hedging with interest rate swaps, inflation-linked swap, and they price their swap by extrapolating the inflation-linked swap curve, and you see, and inflation in the UK has been a lot volatile for a long time, not for a week, but for months. Then, of course, that creates all sorts of huge problems into the financial system. Also because, very simply, when interest rates go up, the value of your bonds, the price, the face value of the bonds goes down. So if you have sovereign debt as your assets and the value of your asset go down, they depreciate, then vis-a-vis what are your exposures in the market, then you need liquidity. And then what happens? To gather liquidity, you sell bonds and the price of the bond goes down, the interest rate goes up, and then you end up in a margin call. So that's why we have level A, level B, level C, 3 levels of collateral that can be given to the Bank of England in a sort of emergency for a 6-month term liquidity line, okay? And if we see here, total amount allocated, it has been growing steadily, okay? Now we are, here there has been a bid on the 11th of November for 6 billion, which mature in 6 months time to get to maturity on the 14th of May 2026, okay? So, when you have, how can I say, when in the same space-time, in a few days, you have a confluence of factors, then that can create a lot of volatility, you have a lot of market activity, then of course you can see that the yield curve basically jumps higher, okay? And I cannot express any judgment, or I cannot have an opinion on this. I can only take stock or try to understand what actually have been the liquidity requirements into the system, because if you put the dots together, you can understand exactly why the yield curve at a certain day, at a certain time, it has been spiking a lot. It has been increasing a lot. That's definitely not because of what rolls over into the newspaper, okay? Because I showed you here, by next week, there are an additional 6.3 billion in short-term repo that have to be repaid, okay? The total amount tapped until now, it's 92 billion, okay? And don't forget, okay, that the Bank of England has done 300, more or less 340, let's call it 340 billion in quantitative tightening, QT, okay? Sorry about that, QT, okay? So here we have, let's make it, put things in order, right? So the central bank, it has withdrawn 340 billion from the system, but at the same time we see that the banking system, it has been asking for short-term liquidity 7 days, and the total amount it's gone up to 92 billion, okay? So if basically the net effect, okay, 92, okay, 248, okay? If we take the total amount of quantitative tightening, okay, and we subtract the 92 billion of repo, these 92 billion, what are? These are sovereign debt, UK gilts, that the banking system also other banks which are not UK domestic banks. I mean, it's not Barclays, it can be Morgan Stanley, I don't know. I don't think so because they use the Federal Reserve. But mostly, almost surely, it's UK banks, and I don't know if UK domestic investment funds or pension funds, of course, they can access the repo, not all of them, but the most important. So what happens is that the banking system, the UK financial system, it has taken in aggregate 92 billion of gilts of sovereign debt, and it has sent back this 92 billion to the Bank of England, and it has asked for liquidity. So what that means is that this 92 billion, it cannot be absorbed into the financial system from quantitative tightening, okay? So it means that too much liquidity, also in terms of reserves level, has been withdrawn from the system. And now the banking sector is going back to the Bank of England with the same sovereign debt and asking for money, okay? So I would like to explain it more clearly. So please understand, because this is crucial. It's a crucial concept. Why this is crucial? Because these are the mechanics that give the hint to the Bank of England to where set the levels of reserves into the system. So the Bank of England, it has taken 340 billion. But the whole financial system, it cannot absorb all this quantitative tightening. So they have taken 92 billion of bonds, and they are giving back 92 billion of bonds to the Bank of England for cash. Okay, so the net level here, it's roughly 248 billion. What that means is that the Bank of England, unfortunately, it would have been better for the Bank of England to stop quantitative tightening at 250 billion rather than going to 340 billion. Why? Not that the Bank of England has done something wrong, because they have to do quantitative tightening, because by the next recession they will have to expand the balance sheet even more. Okay, but this simple arithmetic, mathematics, it gives us the tools to understand what happened. That the Bank of England has withdrawn 340 billion, but perhaps the neutral level of quantitative tightening should have been 248 billion. If we add, okay, if we consider also the 6-month repo, perhaps quantitative tightening should have been less, even less than 248 billion. Okay, because whether it's short-term repo, 7-day repo, or 6-month repo facility for the banking sector, for the financial system to receive liquidity from the central bank, we see that the amounts allocated, they've been growing steadily. So at the same time that the central bank has tried to shrink the balance sheet, the financial system, it basically, after the 200 billion of quantitative tightening of active sales from the central bank, they cannot absorb any more than that. Because whenever the Bank of England has gone above the 200, 220, 240 billion of active sales of UK debt that they have on the balance sheet, then those sales have basically eaten into the ability of the financial system to fund itself. Okay, so okay, let's do. Okay, yeah, 92. I don't know why I'm doing again the same thing. This is very stupid from me. So basically, the banking system cannot absorb any more quantitative tightening, because the repo rate, the repo market, it has been gathering a lot of liquidity. Okay, the total amount allocated, it has grown from 1 billion, okay, to 92 billion. And these are signs, these are clear evidence of liquidity, sort of liquidity distress within the financial sector. Okay, so let me, can I have two? No, okay, no problem. And at the same time, we have also the 6-month term repo facility, which is used by 3 levels of collateral, which there has been used a lot by banks and pension funds for a broader scope, the whole financial system, those that have the credentials that the Bank of England gives to certain financial institution which meet certain criteria that they can access the Bank of England repo facility, so they can post collateral and receive money. Okay, so for what concerns this week, we have here a 6-month repo which expired on the 13th of November of 555 million, right? And on the 6th of November, we had a 6-month repo which expired, and the total amount allocated was 2.6 billion, okay? And here you can see the composition of the amount was 1.3 billion in level A collateral and 1.295 in level C collateral. So it's also the lower quality financial debt security collateral which was posted, and it was quite a sizable amount, the same amount as UK sovereign debt. So when we observed the quality of the collateral that it's provided, it's given, it's posted to the Bank of England in order to have 7 days or 6 months liquidity, we can basically put the dots together, gather the dots together and say, okay, probably some other funds, they have some lower quality paper, some credit derivatives or some other sort of stuff that they deposited, okay, to the Bank of England for 6 months in order to have 1.2 billion, 1.3 billion in aggregate, and then pay back this 1.3 billion in 6 months time. But the quality of the deposit in terms of financial securities is level C. So it's not sovereign debt, but it's lower quality debt securities. Again, it can be mortgage-backed securities. It can be collateralized debt. It can be corporate debt. What that means is that not only banks are in distress, but also other financial institutions. They deal with the housing market, so the mortgage market, or they deal in corporate bonds, or they deal in collateralized loans obligations, so all those sorts of credit derivatives. Okay, so this week, this couple of weeks, we have some 3.1 billion, 170 million in long-term repo, which had to be paid back to the Bank of England. Okay, so what happens is that you have this movement of cash. Okay, so because of the financial system having to pay 3.1 billion to the Bank of England, it can happen that if you are short of money, what you do, you sell sovereign debt if you have it. So these are clear signs, clear evidence of market distress, liquidity market distress, which is not only in the UK, it's also in the United States, in the treasury market. The repo rate, it has been growing recently because there is short-term liquidity, okay, distress. And this liquidity distress, it's caused by many factors, but one of the relevant factor, it's the bubble, the AI bubble. You say, why? Because the bubble requires a liquidity premium, okay? The bubble creates a liquidity premium so that inefficient investors, they pay this premium to acquire this bubble, this asset bubble, which is AI, hoping that they will be profitable in the future or that this will benefit them. And acquiring, so bidding into the asset bubble, basically it acts also as a tool of liquidity for financial markets, for investors, okay? So that's why there is liquidity distress, because the market, financial operators, they are skewed towards the liquidity premium of the AI bubble. So they are long stocks, they do investments in AI firms, and in order to invest into the AI bubble, they borrow, okay? And so they try to get exposure to this liquidity premium, to the asset bubble, in order to gather liquidity premium. So I want to buy AI, I want to invest into GPT or into any other AI company, so they borrow. And they pay a liquidity premium. To borrow, they can use collateral, they can use all sorts of channels. But basically, all this financing that it's fueling the stock market speculation, on the other end, it's a factor of liquidity distress, okay? Which matches up with also the active sales of sovereign debt into the market from the central banks, which tries to withdraw liquidity from the system. So that's why the stock market bubble, the asset bubble, it's a problem, because the asset bubble, it creates a liquidity premium. inefficient investors, they want to bid into the liquidity premium because they want to be exposed, they want to own the asset bubble because they think they will become more productive, they will gain from the asset bubble. And by the only mean of saying, okay, I'm going to invest into AI, can you give me 100 million? Can you chuck in 100 million for me, Mike? Okay, you go to the bank and say, oh, I want to do artificial intelligence enterprise, Mike. Can you give me 100 million? Okay, something from nowhere, I will turn it into somewhere. Okay, it's something like that. So you want a liquidity premium, but you have to pay for this liquidity premium. And so that's why the cost of borrowing, even from government, goes up, because the government debt is the most liquid form of debt security and is the closest form, the nearest form of money or cash, right? If you have a government bond, UK government bond, you give it to the bank, they give you money instantly, right? And if you have a receipts from Tesco, they will probably tell you, okay, better you get some toilet paper, right? Okay, so that's the main distinction. So in this environment, global environment, we have a problem with the AI asset bubble, which causes a liquidity premium. Inefficient investors, they want to bid into this liquidity premium. They have to pay because they want to acquire the asset bubble. They want to acquire the asset, which is an asset bubble, okay? Because they hope that in the future they will become more productive or that they will gain from this asset bubble, which is not, okay? Because it's a bubble, okay? It's a debt that it's overinflated, okay? So it's hundreds and hundreds of billions, if not trillions, of very bad debt, okay? And all these factors, they generate volatility into the market, into the debt market, okay? It can be corporate debt, but it can be also sovereign debt. So we have 3 or 4 things that have gone on all together this week, the past week, which have generated this sort of 200, 150, 200 basis point volatility in the gilt market. And it's not, definitely not fiscal policy, okay? It's not fiscal policy. Because here we have 92 billion in short-term repo. So the financial system, the banking system is short of liquidity. They are short of cash because the Bank of England has pushed 340 billion in tightening and they cannot absorb it, okay? So they can stop at 240 billion, they can absorb. But if the Bank of England wants to withdraw more than 200 billion, then the banking system, the financial system, okay, the sterling money market system, they cannot absorb it, right? And so they take the same bonds that they had to buy, they had to receive from the Bank of England, and they give it back to the Bank of England, say, okay, mate, I cannot absorb all this tightening, you give me some cash, 7-day cash, okay? And this 7-day cash, it has grown from 1 billion to 92 billion, okay? And now next week, there is an excess of 6.3 billion, which have to be repaid from the banking sector to the Bank of England, right? Let's do it again. 92 billion minus 85,687, we have 6.3. So there is an excess from one week to another, from one Thursday to another, the Super Thursday. It's basically the repo facility, all this rubbish that goes on from the Super Thursday. I cannot say any more than that, because that is propaganda to distract people. Now, for Thursday, the 20th of November, there is a 6.3 billion additional to be paid for the short-term repo, 7-day to 7-day, okay? Now, if we go and see the long-term repo, what are the operations for next week, okay? 20th of November, we have 720 million pounds which are expiring. And so the financial system, so we have 6.3 plus 720 million, we are at 7 billion pounds, which from the financial system and the banking system have to be paid back to the central bank, plus the cost of borrowing, okay? I hope these amounts do include the cost of borrowing for the repo rate. I forgot to check the Bank of England repo rate. So there is 7 billion pounds at least that within next week we'll have to move from the banking system, from the financial sector, back to the Bank of England. And that is net liquidity that is drained from the system, okay? But while this money goes back to the Bank of England, then they will ask for more, okay? They will activate the repo and say, okay, mate, I'm going to pay you back, but I need this money for another week, and another week, and another week. And then you come back and you say, no, I need the money that I ask you, I'll pay you back, but this time I need that and some more, okay? So, because they are shorter and shorter and shorter of liquidity, and if they use this short-term liquidity to invest into the asset bubble, they pay a liquidity premium, and they are exposed to the asset bubble. But overall, that causes distress into the market, which is a liquidity distress and a sovereign debt market problem, because all this collateral goes back and forth from the banking system to the central bank, from the central bank to the banking system for 7 days or 6 months. Okay, the repo facility, it does work like that, but we see the Bank of England has tried, the central bank has tried to withdraw liquidity with quantitative tightening, but after some threshold, which is above the 200 billion level of shrinking the balance sheet, the financial system cannot absorb more of that, and they start to tap into the repo facility, into the short-term liquidity. And those are the first signs that the level of reserves, they are going below what is the level that guarantees the functioning of the interbanking liquidity, the overnight, the SONIA rate, and all that stuff. Okay, and so what happens is that because interbank liquidity, it's a bit tricky, then they have to use the repo facility. But now, total amount next week, it's 7 billion, right? And if we go to 27th of November, we don't know, okay? But on the 27th of November, for sure we know that a 6-month inflation index-linked gilt repo liquidity of 6 months is expiring. And so we have 1 billion that the financial system will have to pay back to the central bank for the 6-month liquidity facility that they activated on the 27th of May 2025. After 6 months, which is 27th of November 2025, which is 1 day after the budget, there is the 6-month index, etc., level A, level B, and level C collateral, which has to be paid back to the central bank. Okay, and so every week there is this back and forth. But if we go to the last row here, okay, so next week, the financial sector will have to pay 720 billion. Or the week after, or the day after the budget, the financial sector will have to pay 1,083 million to the Bank of England for a 6-month liquidity. Now, if we see here, these are the most recent 6-month repo liquidity operation that have been done by the Bank of England. So it means that it's money that has been asked, it has been required in the past 2 weeks, and it will have to be repaid in 6 months' time. Okay, so we see here on the 4th of November, the banking sector has asked for 3.7 billion, and on the 11th of November, they have asked for 6 billion. Right? Do you understand? And see how things match up, because now we start to see something very interesting. Because in this week, there have been, on the 4th of November, there has been also a treasury gilt option. So the government has sold a 4% treasury gilt, which with maturity 2029, and it has sold 5 billion. Okay, so also the government has thrown into the market another 5 billion of gilts. And of course the yield goes up, because you have repo, 6-month repo, short-term repo. The government does outright gilt auction, so it has to place additional public debt into the market. And so, of course, the yield curve goes up, because the government tries to do the sovereign debt tries to raise money, while the banking system is scrambling for short-term liquidity, and the two don't go together. They don't go together. Okay, so now I am not in the place of expressing any judgment or whatever. Okay, I'm really not interested in judging anything. I'm just doing some simple arithmetic, if I can. So here, okay, from 1 week to another, we have 92 billion. So there is a 6.3 billion additional in short-term repo, which have to be repaid on the 20th of November. And look, here, on the 11th of November, there is a 6-month repo, which has asked for 66 billion liquidity. It's very, a lot of, they match exactly, but it's more or less it's the same amount. Okay, now next week we have 92 billion expiring. Okay, and there is 85 6.87. So the short-term repo has increased by 6.3 billion. This repo lasts for 7 days. But on the other side, we have that the 6-month repo, there has been an auction basically. So some banks or funds, I don't know who, on the 11th of November in aggregate. The 11th of November is the operation day the Bank of England accept collateral, level A, level B, level C collateral from eligible participant to the 6-month repo facility. And they have asked in aggregate for 6 billion, which is for a 6-month term, which is exactly how much here it has grown the short-term repo facility. So I don't know if they have asked for a loan of 6 billion, which will have to be paid back in 6 months' time to pay a loan of 6.3 billion, which is due in 7 days' time. Do you get what I mean? Do you get me? Do you get what I'm trying to say? Is that they asked for a £6 billion that they will have to pay in 6 months' time. But here, from 1 week to another, we have an increase of 6.3 billion in the short-term repo. So I don't know if it's robbing Peter to pay Paul or something like that. I have no idea. I'm not suggesting anything at all, because probably I have, along all this discussion, I have made a lot of mistakes. I have probably said things which are not entirely correct. So if I have been wrong on something, I apologize, but I'm not Wikipedia, which I know everything. I'm a human, I can make mistakes. But according to my humble knowledge, if I see these two amounts, not that they are pretty similar. So I have a genuine doubt that I don't know if they have asked for 6 billion to be paid back in 6 months just to service this short-term repo in 7 days' time, which is roughly 6.3 billion. Because if it's like that, then it's quite interesting. I don't know if it's an additional sign of liquidity distress, or it can be actually a method for the banks or some speculative funds to fund themselves, to gather liquidity on a 6 month horizon, and then also to use the long-term 6 months liquidity to pay back the short-term repo and do some other stuff. I don't know, because I don't know everything. I can make a mistake. That's probably almost sure that I can make a mistake. But all these data bring to the fact that it's natural. It's of course it's the consequence is that the yield curve basically becomes more volatile. So that the UK sovereign debt market becomes more volatile because there is short-term repo rising 6.3 billion. The total amount is 92 billion. In the past 2 weeks, for a 6 month operation, we have asked for 673 plus that's another 9.6 billion plus 695. We are at 9.7 billion. Okay, so this 9.7 billion has been basically asked to the Bank of England and will have to be paid back in 6 months' time. But the short-term repo, it has accrued to 92 billion. And on top of that, you have the government, which is doing bond auction, is selling debt into the market. They are trying to raise money, okay? And so this week, on the 4th of November, which is here, the same date here, the government, as the DMO, has basically opened an outright gilt auction, and they tried to raise 5 billion, okay, for this debt security, a 4% treasury gilt, which expired 2029. So it's basically a 4-year, okay. And yield tail at auction, you see that the yield tail is 0.4. It's a substantial. The tail basically it's 0.4%. It's how much the yield required by those who participate in the auction varies from what the government is proposing to pay. So the government is issuing a 4%. By rough rule of thumb, let's put it like that. Some gilts have been placed at 4.4%, which is a lot. I'm making a mistake, but the tail in the auction is probably less than that, but it's not 0.4. 0.4 basis point. Oh, it's in basis point. That's why it seemed to me excessive. 0.4 basis point. Okay, so it's a pretty small volatility in the yield. I apologize for my mistake. It's better to read everything all the time. So 0.4 basis point is less than 1 basis point. So it's a small, but the yield tail as a concept, it's how much the yield to market when there is a bond auction varies. So how much volatility there is in the government auction of sovereign debt. But nevertheless, the government is selling debt on the 4th of November, and they carried also a 30-year gilt auction on the 11th of November. So they raised something between 5 and 7 billion. On this page, I don't have the. It's not recorded the auction of this week. Probably it will be updated. Okay. So the Bank of England, as I can see here. Okay. I will have to, okay, because it says here the Bank of England standing repo facility rate is 4%. I don't know. I don't find it actually possible that the bank rate and the repo rate are the same. But anyway, the bond market, call it chaos. It's not because of fiscal policy. Okay, very simple thing. You need to search for the data and understand what goes on into the market. And we have 6-month repo, and just on the 4th and 11th of November we have totaled 9.7 billion in liquidity required by the financial sector from the Bank of England. So they have sold 9.7 billion on financial debt securities, level A, level B, and level C, and we have here the composition. So there are 7.6 billion and 7.6 billion, almost 7.7 billion of level A collateral, which has been deposited to the Bank of England in order to receive cash, 7.6 billion pound sterling deposit into the bank, okay, a sort of bank reserve, okay. So in these couple of days, in the couple of weeks, 7.7 or 7.690 billion in sovereign debt has been mobilized from the financial sector towards the Bank of England, and they have received cash and they have to pay back in 6 months' time. So if I'm moving 7.7 billion of gilts, then the market is gonna move, is gonna notice, for sure, okay? And if at the same time the banks they mobilize an additional 6 billion in the short-term repo, okay? Because the short-term repo from this week goes from 85.6 billion to 92 billion next week. It has grown by 6.3 billion. The bond market is gonna notice, okay? It means that the short-term repo, there have been an additional 6.3 billion of UK gilts, UK bonds, which have been deposited to the Bank of England for a short-term repo, and then they received cash. But in 7 days' time, they will have to do this transaction again. So because of this, the sovereign debt going back and forth to the repo facility, or going back and forth to the 6-month repo facility, and at the same time you have the government trying to raise debt with the DMO gilt auctions, the bond market is going to notice. And what happens is that the end result is that you have a huge increase, 200 basis point increase in the yield, in the cost of borrowing, okay? And then eventually you can start to do all sorts of imagination and speculation about what is going to be this or that budget or whatever. But in money terms, what counts is this data. These are transactions that happen into the market. And so when the debt goes back and forth, and we go from 80 to 90, 95 billion, 97 billion, 92 billion, so forth and so on, it means that there is short-term and 6-month term liquidity distress into the market. For sure there is short-term liquidity distress because the Bank of England has withdrawn liquidity from the system, right? See that the Bank of England has shrunk its balance sheet here, okay? And I don't know if they can do more QT. I don't know if they can do it. It's something that they will have to double check with the other people in the financial system, because they can see, of course, it's their business when they see that the short-term repo goes up and the repo facility, it has to work this way. But if this is a reason and a factor of distress, liquidity distress, then it can cause all sorts of financial stability problems. And the financial stability problems, then they become interest rate volatility, and it becomes yield curve volatility. And the yield curve volatility then becomes a problem for the government when they have to do, or the DMO, when they have to do sovereign debt auctions. Okay, so it's all a mechanism, it's all a chain of things. They are all linked one to another. Okay, so these are all the things that have been happening in the gilts market, in the repo market, the Bank of England, the financial sector, the banking sector, just this week, in the past couple of weeks. Okay, and that's why the yield curve has gone up, because more and more, larger and larger amounts of debt had to be mobilized for the short-term repo, for the long-term repo here, long-term 3.6 billion, 6 billion. So larger amounts of debt have been moved from the financial sector to the Bank of England. This can cause some volatility. Of course, it's less volatility than selling into the public market the debt security. But nevertheless, whenever banks or financial institutions or funds, pension funds, they are short of cash, then the bond market is going to notice for sure. Okay, then the yield curve is going to react. because the banking sector is short of cash, or there is short-term liquidity, or they want to participate, they want to acquire, they are trying to gather the liquidity premia in order to buy the asset bubble, which is another problem on the other side. And at the same time, you have the government, which has to do the sovereign debt auction to raise money. And so all of these things together, and many other factors, they are the main causes or the main reasons of Friday sell-off. But it's not a one-off, okay, because the yield curve has been rising for some time, okay. But if you see, the bottom was the 11th of November. And the 11th of November is not for any other reason, because there is the long-term repo, which went on the 11th of November, okay. On the 11th of November, you have 6 billion of level, 5 billion of level A collateral, 118 million level B, 19 and 10 million, almost a billion level C collateral, for a total of 6 billion and 73 million, which basically was deposited to the Bank of England for a 6-month repo, okay. And so if we go and see here the chart of the yield, the bottom, and then you have a huge volatility going off. Why? Because between the 11th of November, you have the index repo, and it's 6 billion of debt that goes from the market to the Bank of England, and it's a sort of liquidity distress. On top of that, okay, between the 6th and the 13th of November, you have the 85.6 short-term repo, and then an additional 6 billion sterling had to be refinanced for next week. So this volatility, I'm not so sure that is going to go down. There is going to be more volatility from now till December, I don't know. For as long as there is this short-term repo going on, okay, that's why it's not a question of fiscal policy. For as long as you have this short-term repo facility growing, that's a clear sign of short-term, near-term liquidity distress into the market. And again, if we have an asset bubble, funds, they are going to bid for liquidity premia, and they want to acquire the asset bubble, which means that the cost of borrowing is going to increase, and a lot of bad debt is going to be created to acquire an asset bubble, okay, an overpriced asset, which in this case are, I don't know, ChatGPT, okay. It's as if from one week to another, financial funds have asked for 6 billion sterling to buy ChatGPT, okay, you do ChatGPT.com, okay, 6 billion. Okay, so that's the main problem. And of course, on the domestic side, on the internal UK financial system, there is a 4th of November auction. There is on the 12th of November, then they carried another 30-year bond auction. And all these factors, they create interest rate volatility. So definitely, for what I can understand, it's definitely not the headline in front of the eye, okay? What is in this case, the headline in front of the eye is definitely the imaginary unit on the y-axis on a Cartesian plane, okay? It's definitely that. It's definitely the imaginary unit of the square root of -1. Or what is the headline on the Telegraph or the rolling coverage and all those stupid things. No. What counts is money. And we have the short-term repo, which to me it's a cause of concern, and it's a clear sign that the financial system, the sterling money market system, they cannot absorb any longer any QT. And there is an asset bubble. And we have the whole financial system which is bidding for liquidity premium, which in the short term can give you some short-term gain, but you are acquiring an asset bubble. And then down the line, you are going to be even greater distress, because you are acquiring an asset bubble by bidding liquidity premium, so you are bidding for inflated debt. That debt is going to be write-off. It's not worth 100, it will be worth 60, 50, at worst 20 or 30 cents on the dollar, on the pound. Okay, so those are the consequences down the line when the whole financial system, they bid for liquidity premium in an asset bubble. And there are so many other consequences, because that stuff is going to hinder the fiscal policy space for auctioning debt, because financial institutions which already are in distress because they need the short-term repo, they go speculating on AI, and they are short of money to bid for sovereign debt. Or quite the opposite, they use gilts as a collateral to bid on crypto. Okay, so those are the things that happen into the market. And the Bank of England, they can basically stop QT, but then they cannot regulate the behavior of financial institutions, okay? But then down the line, when the bubble goes haywire, then the liquidity premium is going to evaporate, and then it's gonna be even a bigger distress, liquidity distress into the market. And I hope I've tried to explain with many lengthy words, repeating again this concept. Although I have not been so like the top of the top, but I hope you enjoyed the video, and yes, please subscribe if you're new around the channel, leave a comment, watch my videos. I will upload more content in the context of the fiscal budget, because at the minute I'm carrying my own research on the fiscal policy, on all other things. So I will do at least another video, another content, where I'll try to explain what is my own research and what I would do if I had to decide, I don't know, not decide fiscal policy, what is my idea of a budget, or I don't know, how can I put it better? Not what is my idea. I will show you my research, okay? I don't have an idea. I have my variables, I have my models, and having analyzed all the variables, I know that the UK economic engine works this way, the other way, this way, the other way. We have a negative fiscal multiplier, you have a flat Phillips curve. So what ideally should be the choices to make in order to adjust something, or I don't know. So I will keep you updated with more content. And for that, thanks for watching, and see you soon.